Welcome to our series from Montage Services on tax matters. Today we're talking about the double Irish structure, which got a lot of press recently due to Apple and Starbucks and some other well-known organizations. Before we get started on that, what I'd like to do is just introduce you to Montage. We're a professional service organization that has offices worldwide in San Francisco, Houston, London, Toronto, and Berlin. We provide tax and accounting services as well as professional business consulting services. So what is a double Irish structure? It is an intellectual property transfer. What I mean by that is it is a tax deferral structure for U.S. companies. Companies that have IP, intellectual property, that is valuable to the profit that they're making. And through this structure, they defer the U.S. tax on the revenue that they receive. How do they do this? Well, the first step is to choose a location where they want to transfer that IP to, and then through an intercompany contract, they, in essence, sell their IP, the foreign rights to that intellectual property, to that foreign location where they've set up this IP holding structure. The common locations for these IP holding structures are in low tax jurisdictions, such as Ireland, Switzerland, Hong Kong, or what we call a pure haven, such as the Cayman or British Virgin Islands. What we're going to talk about today is the double Irish structure. The reason for that is most organizations that are publicly held, and this can also apply to privately held organizations, try to be good corporate citizens. They have a board of directors, and they need to explain why it is they're transferring offshore their high value asset, which is their intellectual property. And they usually pick a location where they can justify hiring people and it doesn't stand out as a pure tax haven. So that is why Ireland is often chosen. The effective tax rate through this structure is 2.5%, which means any revenue or net income that is generated outside the United States would be taxed at an effective rate of 2.5%. And what's good about this is if an organization chooses to be doing an intellectual property transfer, they are in good company, which is to say that other multinationals have done this and publicized it, such as Oracle, Google, Microsoft, the names go on, Apple, and so forth. And these companies that I've just named used Ireland. So what does the structure look like schematically? What we have is two Irish companies. One is called the Irish Operating Company, and the parent of that is the Irish IP Company. They are held in this manner 100% by the U.S. company. Oftentimes, then there are sales or marketing companies that are held underneath those two Irish operating Irish companies. What's important to note is that the customer base eventually contractually ends up working with the Irish operating company. So if there's a software license or a sales transaction, it is with the Irish operating company, which previously might have been with the U.S. company, so that has to be assigned down within the intercompany group. If we look at some dollar amounts and just use a simple example, you can see the power of this. Let's say the Irish operating company sells a product or a service or a software for $100. It will then pay, because it doesn't have the intellectual property rights, $80 up to the Irish IP Co. That leaves $20 to be taxed at the Irish corporate tax rate of 12.5%, which means that it will pay $2.50 of tax. That effective rate on the $100 comes out to be 2.5%. There is no tax paid by the Irish IP Co, where the $80 went, and none of this income is brought back to the United States, so there is no tax until cash is brought back in the United States. And most people are aware the U.S. has a combined effective rate of 40%, so that has saved the difference between the 40% and the 2.5%. What are the steps involved in order to get this completed? It does take some time, and it does take a little bit of setup. But once in place, it has a benefit going year in and year out. So you need to set up the two Irish companies. The Irish government approves this and actually wants companies to set up in Ireland because they know it's going to drive business in Ireland and eventually people will be hired in Ireland. Then once those companies are set up, there needs to be some intercompany agreements put in place. They're called the buy-in payment of the existing intellectual property and some service agreements as well. These are under our U.S. transfer pricing rules. The Irish operating company starts working and operating as well as the IP company for a period of 6 months. After that 6-month time frame, the Irish IP company needs to break residency with Ireland. How it does that is it holds a board meeting in the Cayman Islands or the British Virgin Islands, choice of yours, and that in essence breaks the residency to pull management out of Ireland such that it's no longer taxed in Ireland. That is a different concept than the U.S. has, but that is legal and it is the law under Irish principles. Then the Irish operating company will enter into a license agreement with the Irish IP company, and finally the Irish operating company will start selling its goods or services to the public. What are the U.S. tax consequences? Well, the U.S. government, as I said, allows this to happen. The IP has to be transferred out at a value, and that can be paid out over time, so it's not all taxable in one period. Once it's outside the United States, any dividends or other distributions back to the United States will be taxable to the U.S. group. But if it is held outside, there is no tax in the United States. You also have to ensure that there are anti-deferral rules, or we'll call them the Subpart F rules, which you can hear of in another presentation, that are being adhered to. And finally, money is left offshore to grow the business internationally. That is extremely powerful because it's almost like a loan from our government of 40% to keep your money offshore. Finally, there are some other considerations. Clearly, as we discussed, the location of your IP company. Should it be in Ireland? Should it be in Switzerland? Where are you most likely to have people and business reason for being in that location? You have to consider value-added tax, or VAT, which is not something that we pay here in the United States, but is somewhat similar to our sales tax, and that does apply when using Ireland. You also may have needs for cash in the United States. That will cause some tax leakage from this structure. So not to be concerned, it's just a matter of whatever cash you bring back is going to be taxed in the United States. And then obviously there are costs in setting up this structure and maintaining it. Overall, we have great experience in this area. We have established double Irish companies for our clients. And if you have any questions, we would ask that you please contact us and we'll talk you through it. So for now, does anybody in the audience have any questions?
I have a question. I've heard about a Dutch sandwich as part of like a income deferral unit. What is that? Can you explain that a little bit?
So the question raised is, we've talked about a double Irish, and now somebody has asked, what is a Dutch sandwich? Well, I don't know technically if it's a sandwich that you eat, but it's something that can play into this, in that if the technology that is being transferred, the intellectual property, is patented technology, then you do need to have the Netherlands involved, otherwise the royalty will attract a withholding tax. However, if it is software that is not patented, you can just use the Irish companies to retain the deferral without having any withholding tax apply. Are there any other questions?
Does the Irish government encourage this way of double Irish structure?
Question was asked on how the Irish government treats these structures, and the answer is that they are quite positive on double Irish. They have seen where these structures actually bring money into the economy, into Dublin and other jurisdictions, by requiring some substance to be in these Irish companies. So eventually people will hire engineers or maybe some salespeople, and that has shown to increase the economy in these locations, in particular in Dublin, and it's one of the Irish government has actually said to other countries in Europe that they will continue this policy of keeping this structure alive. Thank you.